previous video, we talked about profit and loss reports and how to read those as a salon owner. Today, we're going to look at the balance sheet. There's a different type of report, shows us different things, but it's also so important in understanding the financial health of our business. A balance sheet is broken down into three main parts. One, assets, what you own. Two, liabilities, what you owe. And then three, the equity section, this is what's left over. So I like to think about it in terms of those three O's. What you own, what you owe, and what's left over. Let's look at a real example. Here is the balance sheet for our favorite salon, ABC Salon. We've got some real numbers here, obviously through a fake company, but we can see here the same format that we just talked about. So we have our assets, those things that we own. We'll have our total assets down here. We've got our liabilities, those things that we owe. See the total for that down here. And then our equity, those with the leftover, literal difference, assets minus liabilities, down here. One thing to note with the balance sheet, something that makes it a little bit different than a profit and loss, is that the profit and loss is something that shows a period of time. So we will look at a profit and loss, let's say from January through December. We're looking at a year, and that will be our revenue for that year, our expenses for that year. It's over a period of time. A balance sheet is different because it shows balances. It's always as of a point in time, a single day, and what the balances were on that day. The day that's picked is usually the end of a month or the end of a year. So you can see what our balances are. They kind of represent how we finished a period, but the balances themselves are as of that day. If we ran this report on August 30th, it would probably be slightly different. If we ran it on September 1st, it would be slightly different. So let's look at our balance sheet for ABC Salon and see how it's looking. See what this salon is doing, what's good, what's maybe not so good, what its opportunities are. So we can see that it has three bank accounts, two checking accounts, one savings account, for a total of about $33,000 saved up in cash. This is not a bad amount, not as good as it could be, but could be a lot worse. We have two other assets here. So in this case, we have one, it's employee advances. So ABC Salon gave an advance to one of their team members. And so it's an asset because they've prepaid something. It means that later when payroll is run, we will pay $130 less than we would normally have to. So it's an asset. Inventory. This is a really important one to track for salons. We want to know what our inventory is on hand. So this is usually our retail and our back bar. We can even track them separately as long as we have that detail and can get the reports that show us how to do that. But by tracking our inventory, it really lets us see better the flow of the business, like how it's doing in a given month. Because if we're not tracking it on the balance sheet, what that means is that our ups and downs of inventory are showing up on the profit and loss instead. Every time we buy product, it's going on our expenses if we're not tracking it on the balance sheet. So that means that in a month when we stock up on a lot of inventory, maybe we're getting ready for the holidays, it's going to make that month look terrible. It's going to make it look like we had a huge loss because we had all of these expenses, when in reality we were just building up our inventory. We haven't actually sold it yet. And so maybe that month was a great month in reality, but it's looking bad because we didn't track the inventory appropriately. And the opposite can happen too. We can have a month where we didn't buy inventory, we ran our balance down, and that month looks very good because we didn't spend any money on product even though we sold a bunch of product. So that would make that month look extra profitable. And so that's why it's really important to track inventory. And if that's confusing to you, we will do future videos just on inventory because this is such an important topic and also a pretty complex one. And of course, you can always reach out to us if you have questions or want help. So in this case, when we take their bank accounts, the little employee advance, and their inventory, this salon, ABC Salon, has a total current assets of $47,197.76. Current assets meaning those things that are a little bit more liquid, that are more likely to turn into cash on the shorter term as opposed to further out. Then we come to fixed assets. So these tend to be more of those long-term assets, those long-term things that don't necessarily become cash very quickly. So accumulated depreciation, I'll come back to in just a second. But we have here furniture, fixtures, and equipment. This could be couches, stations, mirrors, could be equipment itself, maybe some shears or blow drying stations or whatever. A lot of things that it could be. We also have intangible assets. So these might be non-physical things. It could be when you buy a business from someone else, then there's some value to that that's beyond the things that are in the salon. It could be if there's a non-compete, that can have a value as well if you're buying from a previous owner. So those things also get tracked and they get expensed over time. Leasehold improvements. So this might be a build out. This could be you renovating a location and making it fit for the salon vision that you have. And that can be very expensive. We can see in this example, $130,000 was spent on leasehold improvements. That's a lot of money. We can't expense it all at once per tax rules, but that's what this accumulated depreciation line is. And this is something that your CPA will take care of. You shouldn't have to do this yourself. But basically, the furniture, the intangible assets, the leasehold improvements, all of those things can be expensed over time. So typically each year you get to expense more of it, you get to write off more of it, lower your taxes. And so that's why that is an important number. And eventually these will come to $0. This would come to zero unless we're getting more fixed assets over time. Two last assets for this salon. We have undeposited funds. So undeposited funds means money that you've started to collect. Maybe you've earned it, but it hasn't gone into your account yet. So typically this means your clients have come in, they've done purchases, they've had their services done, they've bought product, they've swiped their card. So you've earned the money, but it hasn't hit your bank account yet because the point of sale system takes 1 to 2 days to put the money into your account. So that in between time would be something called undeposited funds. In this case, we also have a loan receivable. So ABC Salon has lent money either to another business, to an individual, maybe one of the shareholders had to borrow money from the salon. And so this is them tracking that as it's being paid back. It's an asset for the salon because it is owed money from someone else. $226,543.36. That's the total assets. Those are the things that are owned by ABC Salon. And then we come into the liabilities. In this case, there's 4 things in the credit card section. We have 3 actual credit cards and then 1 line of credit. And we can see that those add up to $127,847. Again, these are the balances as of August 31st, as of that point in time. So some of these, the Amazon credit card, for example, the US Bank Visa, those might be paid off every month. So they might not feel like a debt, but as of this point in time, that's the amount that was on the card. That's an amount that the salon owes to the credit card companies. So that's important to track. Some of these might have balances that are being held and they're not being paid off all the way. And we're still tracking it. We still need to know what that is. And then hopefully we can watch this over time. We can put a plan in place so that we're paying those debts down. $127,847 in credit cards, or with the line of credit, getting to that number is kind of high. So in this case, that's probably one of the things that the owner of ABC Salons would want to do, is come up with a plan for attacking that debt, for working it down over time. Whether that's freezing cards and then paying them down over time, creating a debt snowball plan, whatever it might be, just creating something so that they can approach that with some intention and some improvement to get that going. Okay, here's kind of the opposite of what we had up top, where in our asset section we had a loan that was owed to the salon. Here we have some things that are owed to others. So in this case, there's 2 shareholders for ABC Salon. We've got Annie, we've got Betty, and they're each owed some money. Maybe they put money into the business and the business is tracking that and then paying them back. Let's see here. We've got payroll tax payable. So this would just be taxes that are owed. We've got a sales tax payable, a simple IRA, so a 401k or a retirement. These are all things that the company needs to pay. It's got some sales tax that it needs to pay, payroll taxes to pay, and 401k contributions to make. So those are tracked on here as things that are owed, because that's the reality of what they are, and that makes it a liability. And those are all the current liabilities. And then we have one longer term liability, which in this case is an SBA loan. It's a common loan that a lot of businesses have. So it tends to be a larger amount as well. So in this case, $78,000. So that's important to track as well. And again, as we're making payments, that should be going down over time. In this case, our total liabilities, those things that we owe, is $224,000. And when we compare that to the assets, $226,000, there's not a big difference. So we have a little bit more assets, a little bit more things that we own than those liabilities or the things that we owe, but maybe not the spread that we'd want it to be. And we see that reflected here. The literal difference between those two numbers is $2,223. So that's how you can read that balance sheet and how you come up with the equity number. The equity number does have more detail in what leads up to that. So in this case, we see that Annie and Betty each contributed $10,000. This probably happened at the beginning of the business's history. When it was first started, they put that in, and that was their founding contribution and represents their stake in the business. And in this case, you can see that it's equal. Annie and Betty are 50-50 partners, and that shows in the distributions. So when they take money out of the business, in this case, they've each been paid a little over $21,000 from the business. It's the same. It's the same number. And we want to follow that. So when there's multiple owners in the business, the percent of your ownership is the percent of the distributions or the draws that you get from the business. So if Annie was an 80% owner and Betty was a 20% owner of the business, Annie would get 80% of this $43,000 and Betty would get 20%. And we want to follow that. That's really important for taxes and then for just maintaining that equity split and that ownership as we go along. ABC Salon also has $25,000 of current year profits. So it's great to see that they are profitable on the year. And they have $45,000 in the account that's called retained earnings. So retained earnings is a number that represents all of the past profits and equity of the business. It usually only changes once per year. As we come into January of a new year, the net income for the prior year rolls into retained earnings. And then that number is set for the year, and the net income number starts over for the year. So there we have it. ABC Salon is fairly healthy, okay cash. We've got some inventory on stock, a few other small assets. A concern for it is going to be these current liabilities, these credit cards. So we want to make sure there's a plan in place for that. Some other loans, but none of them are nearly as significant. And then in terms of equity, we see some positive things. We see that net income for the year. We see that over time it has been profitable. Its equity is positive, so that's good. Equity is kind of a rough gauge because assets and liabilities, we want our assets to be higher than our liabilities. But it's not a perfect gauge. But in general, we want it to go up. We want that to be the biggest number that it can while serving its community, while serving the owner and rewarding the owner in good ways. So there we have it. Here's our review of the balance sheet and how you can walk through it, how you can understand it. It's really important to stay on top of this and to see this so that you can see when things are happening. You can see if your inventory, for example, is going down over time, or maybe it's the opposite. Maybe it's getting out of hand. We're just stocking more and more, but we're not moving it. We want to be able to see that. We want to see that our debts are going up or going down. We want to know where we're at. So by using the balance sheet, especially in conjunction with the profit and loss, we can have a great sense of our salon's financial health. And that gives us more power, gives us more information so that we can make great decisions in our business and keep growing, keep moving forward, and build something that really serves us and our lifestyle. Thanks so much.